All right. I start this webinar with a couple familiar slides, but I also want to start it with a quick story. I come from the trading floor in 1996 as a young kid, ARB clerk, wanting to trade my whole life. I get few years as a clerk. If you guys ever seen, how many guys have seen video of a trading floor when it was before computers, all the yelling and screaming? I was one of those guys as a worker, a clerk, and then a trader for about 8 months. Total about 5 years on the floor. Both exchanges, the CME and the Chicago Board of Trade, two of the bigger exchanges in the world, happen to both be in Chicago. Now, telling you this story because I didn't go down there to become and stay a clerk. You can get paid pretty decent, but it's a thankless job. I wanted to trade. So I finally paid for some education that wasn't cheap, but it was good, and how to be a pit trader and what to look for. And then I got my membership, which cost another $1,200 just to apply, go through that process. And now I become a member of the Chicago Board of Trade in the fall, late summer, fall of 1999. Put my jacket on, paid $250 for that. I got my cards, paid money for that. So there's a lot of expenses getting into this business now or even back then. I get in the pit and I can't raise my arm. And that's what you do in a pit environment when you trade. You got to raise your hand, bid and offer, yell and scream. Now, I was a pretty aggressive guy. I wasn't shy, but I couldn't trade and I couldn't figure it out. And you always get the advice like, read this book, read that book, the psychology. I remember a book I read, Feel the Fear and Do It Anyways, because I thought it was fear that wasn't allowing me to be active. So I'm not making money. I'm not losing money. I'm not trading a lot. I'm managing my risk by inactivity, but I'm showing up every day trying to make this work. I was in the Dow futures pit at the Chicago Board of Trade. And in the, it happens that I get a friend of a friend who tells me about a prop firm. Now, how many people know what a real prop firm is or think you know what a real prop firm is? So a real prop firm isn't necessarily these companies that will fund you if you pass some sort of combine. It's not a real prop firm. A real prop firm, someone who hires you, they have skin in the game, they invest in a salary and a small draw, and you trade their money. But they have risk that they take, and that's a real prop environment. I didn't know what it was either. It was early 2000. So I find out it exists, and I won't tell the story about getting hired and everything else, but I will tell you the story, the epiphany that I had once I got hired, what made me go from not being able to raise my arm and trade in the pit to actually probably over trading on the screen. And it was this word was removed from my skill set. Randomness. In the pit, I had no idea where price was going next. It was random. So why would I buy it if I don't have any edge or advantage to think or know it's going to go up? Why is it going to go up? Why is it going to go down? Because of that randomness created the fear, which was a good fear at the time, that allowed me to manage my risk. Now, in and on the screen, how did randomness go away? I started to understand why price did what it did. I had this moment within the first couple of weeks of my prop career, and it was looking at a screen, literally a chart. I can remember like it was yesterday, and it was of a rally. It was of a market that was going up, and I remember thinking, what makes me so special that if I want to sell the market right there, that people are going to come in after me and be willing to sell it at a lower price? What the hell makes me think I'm so special that I'm going to short it there and it's going to make a profitable trade profitable by people coming in after me? Why would they come in after me? Why would they sell it at a worse price, which is a lower price? And it hit me. I focused on this rally. And what I said to myself was, wait a second, what does it take for the market to go up from this X to this X? Buyers, right? And it must take more buyers, right? But here's what the key was. It wasn't necessarily people that were buying the market that was making it go up. It was people that were also trying to buy the market that was making it go up. Trying to buy it and not getting filled. It's happened to all of us when you're chasing. If you're trying to get out of a loser, or trying to chase to get into a long position, try to buy it at 14, you don't get filled. 15, 16. people trying to buy it not getting filled is really the reason why price rallies. At one moment, when most of the people who've been trying to buy it that caused the price to go up actually do buy it, they turn into long positions, many of them. And that's what creates the ability for them to be the ones to sell it after me at a lower price. That's what makes a profitable short trade profitable when you catch a good location, is when the people trying to buy it finally do buy it. Now, I'm going to break this down and make this as simple as it is. And some of you guys might kind of understand it. Some of you might not, but you have to know this like the back of your hand, or none of the other dominoes in trying to read price action and read order flow are going to fall for you. All right. So let's get into what we're going to talk about just over the next 20 or 30 minutes. I'm not going to go on forever. Keep this short. Pop your questions in and we'll cover them. I always start with this picture of my family. That's me right here on the left. That's my dad on the lower right. Why am I showing this picture? It's important. This saying he said to us, if you know how, he said, growing up, you'll have a job, but if you know why, you'll be the boss. If you know how, you might have a job. If you know why, you'll be the boss. That helped have that epiphany moment, that light bulb moment that I just shared. So the why is what we're going to talk about today. Longs equal what? Shorts equal what? Why does price go up or down? And then how could you use this immediately, this understanding, and start looking at price action and looking whatever tool you use through this lens. All right, let's go to the next slide. Like I said, what do longs equal? I won't keep you in suspense. They equal sellers. And by the way, these next 4 points, the 4 golden rules of reading order flow, are really non-debatable. Nobody in here, nobody in the world would debate what I'm going to say. All right. Not often are you in a webinar where you're hoping the guy is not only truthful, but you're hoping that he's correct. All right. You're going to know I'm correct with this. All right. Longs equal sellers. What does that mean? Don't worry about what it takes to get long. After you're long, I guarantee you, you either put a sell order above and a sell stop below, or at some point you have to. Some people do it automatically, but after you're long, you become a seller. If you read the email for this webinar, it's after you buy it, you're a seller. There's a quote that I used many years ago that people, that rang a bell for people. That's kind of what this means. After you get long, you now are a seller. Don't worry about what you had to do to get long. What did it turn you into? It turned you into a seller. All right. Keep it simple. Opposite of that, golden rule number 2. After you're short, you're a buyer. If you sell the market because you think it's going to go down, you hope to buy it lower, don't you? But you're a buyer nonetheless. After you become a short and open up a short position, you are a buyer. Simple. Nobody disputes this, especially when we're talking about longs and shorts from probably how everybody in this webinar trades and a day trading approach. Now, what makes price go up? Without holding the suspense, you got to look at it this way. This should be, yeah, no kidding. It's more buyers and less sellers, but most people don't think about it this way when they trade and they open up a trading account. It always hit me when someone would be a consumer their whole life and they use certain techniques and concepts to value the price of a car or a house, but then they ignore those concepts and techniques when they trade the price of the S&P mini or crude oil or a stock or options. But you got to go back to that same technique. More buyers and less sellers. Keep it simple. That's what makes price go up. This isn't a combination that you hope to have, that it would be nice to have for price to go up. No, this is a combination that's necessary to have for price of anything to go up. You have to have more buyers and less sellers. And therefore, the buyers will start chasing price up because there's less sellers to sell it to them. We're going to get back to that. But golden rule number 4, what makes price go down? More sellers, less buyers. All 4 of these points are non-negotiable. Nobody disagrees with it. Price goes down because more people want to sell it than want to buy it. Price goes up because more people want to buy it than want to sell it. Okay. Now, if you agree that this combination makes price go up or makes price go down, here's the question. How do you get there? How do you get to this imbalance of more buyers and less sellers? How do you get to this imbalance of more sellers, less buyers before the market goes up or down? Because if you're telling me there's more sellers, less buyers, yeah, there was, but somewhere up here. You ain't going to make any money telling me that it's going to rain after we're both wet. And too often people use price to predict price and not this combination of when you anticipate more sellers and less buyers are about to hit this market, which stacks the probability that the price is going to break or go lower. More sellers, less buyers. If you're bearish and you think price is going to go down. Most people get bearish when it's too late. Price goes down and now they're bearish. Why? Because price went down. No, that's like saying it's going to rain after you're wet, or it's going to rain after you felt a few drops. That doesn't really hold a lot of value as a meteorologist. So if you think price is going to go down, you have to be better at knowing when and getting to how do I get to that point? How do I get back to this more sellers, less buyers concept and read so that when I see these numbers come through the dome or through a footprint or any other way that you analyze the market, the tools that you use, is it getting you to anticipate more sellers and less buyers have just created that imbalance? So far, so good. Nobody disagrees with this. Pretty simple. Now, how do we tie this, the first two to the second two? I'm going to walk you through it. Now, this is not back of the hand to most of, I don't care how many people in here might say, yeah, I know all this stuff. It's not back of the hand to most of you. And it's a different way that it's ever been explained. With all the YouTube videos I got out there for the last 10 years, my concepts, techniques don't change because the weight of value price doesn't change. When you get to people that they're hot on Fibonacci and they're hot on moving averages, and then they're big profile people, it's like, wait a second. Do you bring a Fibonacci chart into the car dealership to negotiate price? Do you talk profile when you're trying to talk price? No, you're trying to get to the identification of maybe more sellers, less buyers, because they're going to get inventory on a bunch of new cars on Saturday. So I'm going to come and try to negotiate price on Saturday because I know they got more sellers, which are more cars on the lot than on Thursday. If you knew that information, you would know when the best chance to anticipate you can get a lower price. You wouldn't say, hey, you guys are trying to sell me this car at resistance on a 618 Fibonacci and price is going to go lower. Good luck. So let's tie this concept to this concept. After you're long, you're a seller. Does anybody got any questions? If you got questions and I don't see them, I will get to them at the end. If you got any questions, pop them in when you have them. And we'll come back to it if I don't get to it right away, but I will get to it. Now, how do we get from anticipating indeed there's going to be this imbalance of more buyers, less sellers, and price could go up? Well, let's go and look at where buyers and sellers come from. They come from other people's positions of longs or shorts. So if we agree that longs equal sellers, after you're long, you now are a seller. It would be fair to say that if you had, well, let's start with more longs. Let me erase some of the drawing. If longs equal sellers and now all of a sudden you have more longs, be fair to say that you had more sellers, wouldn't it? If longs equal sellers, then it's easy to assume that it's not assuming. It's a fact. More longs, more sellers. If you had shorts, and if shorts equal buyers, and shorts puked or exited, therefore you had less shorts, it's easy to then say you have less buying or buyers, right? So do you see how This gets tied back in, and we found how we could get to more sellers, less buyers. This is what you got to get to. If you're picking a moment in time where you're bearish and you want to get short, and you're bad at picking good locations, or you're early or you're late, it's because you're not reading the market when it gets to that point where it has more sellers, less buyers, and the chase is about to happen. In this case, chase to the downside. So more sellers, less buyers. I just got you there. If you could read that there's more longs in a particular area that just opened up a long position, there's your sellers. There's your more sellers. If you could also see there's less shorts because they got shook out, you create less buying below. So you just got to that combination. Does it make sense so far? If you're short, let me just break this into just a short. Let's just think about your own personal trade the last time you took a short. When you took a short, let's say you sold it at this X. You think price is going to go down. That's why you're short. I hope that's why you'd be short. You don't think price is going up and you get short. So you get short because you think price is going down. You're trying to buy it at that circle for a profitable, for your profit target, right? But price doesn't always do what we think it's going to do. And so while it might go down, you're not filled. It comes back up to where you got short. It comes up and you put in a buy stop to cover this short for a loser, right? And you get stopped out right here. What happens to this buy order? I'll give you guys a second to answer it. You just got stopped out of a short trade with a buy stop. What happens to this buy order that was resting below? What happens to it? Goes bye-bye. It gets canceled. Exactly. It disappears. So there's less buyers below. There's less shorts. Less shorts, less buyers, because shorts equal buyers, right? You get stopped out. There's one less buy order below. This will fit in another slide or two, or when I talk about shorts puking. Shorts puking. Puking is a word, slang word from the floor of someone exiting a trade for a loser. But they get stopped out. Means the same thing. Shorts get stopped out. The buy order below gets canceled. So that's just you, and that's just maybe your one or two contracts, right? Well, what if there was a bunch of them? What if there was a bunch of buy stops that shook out a lot of shorts all in here? Then all these bids below go away. Boom, they disappear. Is it easier to go lower if there's less buyers below? Hell yeah. It's not only easier, it's necessary. If you have all these circles are buy orders below the market in the dome, and a bunch of shorts got stopped out up here, guess what happens? All those circles get canceled and go away. So price has an easier way to navigate lower. Is it easy for price to navigate lower if there's all these buy orders that are stuck in the book all in here? No, it's not easier. It's harder. And often it'll go into there and start to come out of it. It's too much support, too much for it to get through. But if you start to remove those circles, then price has that path that it needs to continue lower. Less buyers. If you could add more sellers to it, you accelerate the move. Anytime you're trading and a market goes down fast, it's because you immediately had both of these hit at the same time at a certain point. You had a bunch of sellers had to come to the market and a bunch of buyers that pulled their order. And then you created this combination very quickly. And market went down and went down faster. Like I said earlier, this isn't something that, oh, it'd be nice for there to be more sellers and less buyers for my short to work. It's not nice. It's necessary. It has to happen. It has to happen. And that's for price to go down if you're looking to sell to get short. If you're looking to pick good spots to get short, you have to get this combination to happen after you're short. You have to get this combination to start happening that will qualify a price or an area for you to get short. Let's go to this combination. More buyers, less sellers. That's what you need. That's what's necessary for the price of anything to go up. How do we get there? Well, we need more buyers and less sellers, right? Well, I know, where do I find buyers? I find buyers from people who open up short positions. So if I get more shorts, MS, then it's not an assumption. It's a fact that you're going to have more buyers, correct? How do I get less sellers? Well, let me go to where sellers are. Sellers are turned into from people who open up long positions. Okay. If I get less longs and I get the longs to get shook out, if longs equal sellers, then less longs equal less sellers. So far, so good. So we got to that combination. This is what you need in order to get this. In order to get this. And I don't care if this is coming out of a consolidation and it's a breakout to the upside. I don't care if it's a continuation of a trend that has a little retracement and this is the continuation to the upside. I don't care if it's the market's moving lower all day and all of a sudden it rejects a low and rallies. These are pretty much the three, and this is a webinar for another day, but this is pretty much the three strategies that anybody in here is looking to implement. You just probably need to get, everybody needs to get better at location, but you're either playing a breakout, you're playing a retracement for a continuation of a trend, or you're fading it. 1, 2, 3. All of them have this in common. In order to pick good spots to get long, to implement your bullish opinion, you have to anticipate where you could find an imbalance, creating more buyers, less sellers. You have to think, and this will become something that sticks in your head from this day forward, OPP, other people's positions, longs, shorts. There's a cheat sheet webinar I did for our group that takes all these acronyms. So it's easier for you in the beginning to say, well, what am I looking for more buyers, less sellers? This will become second nature to you. But do you want, let me erase all this illustration. If you are long, do you want a lot of people long with you? When people get early on in this business, and they probably never get to this point unless they heard me or someone like me, but most people would answer, yeah, I want a lot of people long. Hell no. You want less longs. If everybody's long, then everybody's a seller. And if everybody's a seller, it's hard for the price of anything to go up. So if you're long, you don't want competition of other people long with you. It's like if when you were younger and you wanted to go meet some girls and you went into a bar and there were 3 girls and 40 guys there. Go to another bar, too much competition. So the point is, less longs is helpful and necessary for your trade to have the best chance for it to work and for price to go up, because it creates less longs, create less sellers. If you get more longs, you and long and everybody else, that's your 40 guys are in the bar, all chasing 3 girls. You actually have more longs, you have more sellers. That's not conducive for a price to go up. It's actually conducive more sellers for a price to go down. This, and I could have named this webinar, Why Price Moves. Because if you don't know this and think about it in these terms, so now you can go back and you look and say, how do I now read this market to find better locations and better timing to execute, not only to get in, to get out? Read the market, not based on what you think anymore, but what others are thinking that you're trading against. You want a bunch of longs to have just got shook out. Then you're long. and it goes up? How many people know what it feels like to get stopped out of a long position and then the son of a gun rallies 5 seconds after you get stopped out? You get stopped out almost on the low tick, and then it rallies right to where you thought it was going to go, but you're not on the team anymore because you got stopped out. Well, you were part of less sellers. I'm sorry, you're part of when you got shook out, less longs, less sellers. That's why when that happens to you, this dynamic was playing out. You had too much competition. They had to shake those longs out in order for the market to do what it needs to do in order to rally. Can I have too many people selling it if it has to rally? By its very nature, it's not going to rally if there's too many people selling it. Again, the price of anything. Any questions on this slide? This is a basic to those that come through the trading floor and through a real prop firm. And my whole kind of MO or goal, mission statement, so to speak, is to make what's basic to me basic to you. For some of you, this might seem basic. It's not. It's not read this way by most of the rest of the market. Some of you are kind of hearing this explained this way for the very first time. You have to have tools that understand and give you the ability to read if there's in fact too many longs, too many shorts. Did they get shook out? Did they get stuck, trapped? When a market rallies and you're looking to fade it, and you got your resistance level here, are you going to make a living by having resistance levels and putting a resting sell order to get yourself short? Are you going to make a living just with that as your skill set? Hell no. Because then you got to hope price goes, fills you, and goes back the other way. Generally, it'll miss you and then go down. So you miss some of the winners and you catch all the losers when it doesn't work and it flies right through you. You're going to have a skill set to read the market when it gets to an area that you're looking to get short in. And what do you want to see when you're short or right before you're short? What do you want to see now that you understand this a little bit? You want to see a bunch of longs come in and, oh, price is rallying. And I often joke in the room, this little Johnnies are getting long. We rally 8 points and now people are getting long. And that's what makes a top a top. They reach, they chase, they get long, and the market rolls over. It goes back to the story I told at the beginning of this webinar, the epiphany moment. What makes you so special that indeed you could sell it at a particular area and it actually will have people coming in after you to sell it at a lower price or trying to sell it at a lower price because you got more longs up there and more longs that open up longs that became what? Just take it back to what longs are. Longs are sellers. So if longs are sellers, more longs equal more sellers. More sellers is what makes you so special to maybe get short here and have the price cooperate. All right, let's go to the next slide. And then I wasn't really planning on showing the tool that we use at this point. I make sure kind of people understand this before they understand the value of any tool. But I want you to also watch videos to see that we, in fact, have sample sizes of where people get long, short, and then get stopped out. But you won't have to take my word for it because there's some videos that I'll send you that you'll see offers go in the book after a long position was open and such. I'll get into that later. Let me just cover this slide. If you can't see the slide, it's on your end. Can everybody see this slide? A prelude to a chase? Give me a yes if everybody could see it. All right. So Lewis, it's on your end. This slide, I'm just going to roll through this. A prelude to a chase. What does that mean? In order to get better locations to open your longs and open your shorts, you have to be in front of a potential chase. You have to have the market go from balance to imbalance. Imbalance of buyers and sellers make price move. I'll give you an example. If There are 5 people in here who want to buy it, and there's 5 people in here that want to sell it at the same price. Is that price going to move? No. There's a balance of how many people want to buy and sell it at the same price, correct? You often see that in short dated treasuries because there's a lot less uncertainty with short dated treasuries. Let's say a 2-year note, even. 2-year note doesn't move much. Why? Because there's not that much uncertainty like there is in a 30-year bond 30 years out. Buyers and sellers are pretty balanced up and down the book. If they're pretty balanced, the price doesn't move. It's when you get an imbalance of buyers and sellers that is the preface of when this chase is going to happen. The definition of a good trade location is to take a minimal amount of heat and have price go your way ASAP. Is to be right in front of this chase that's about to happen, right in front of an imbalance of buyers and sellers. If you're long, what do you want to see? Come in. What do you have to see now that you've been through that previous slide? What do you have to see if you're long and now you need price to go up? Keep it simple. You need more buyers and less sellers. How do you get there? How do you get to more buyers and less sellers? Because that's what you need for price to go up. If you have more shorts, you have more buyers. If you have less longs, you'll have less sellers. That's how you get there. Always default back to other people's positions, OPP. All right, next point on this slide. So our job is to predict when that imbalance is happening and when it's about to seek rebalance. Because that's what markets do. They're searching for, it's actually called price discovery. They're searching for equilibrium. What does equilibrium mean? To simplify it, it means balancing. If you're not selling cars at $40,000, it's because there's no interest. I got to find where there's a healthy amount of interest, and it ain't $40,000, so price has to come down. The S&P mini is doing that. Crude oil is doing that. The price of any stock is doing that. Houses are doing that. Cars are doing that. And 2-year notes are doing that. 30-year bonds are all moving at different rates, different speeds. A market like crude oil and the NASDAQ futures and the Russell have all this imbalancing happening quick, happening a lot. That's why they move a lot. Let me ask you guys this other question. What is it that you guys trade? Take a second to pop that in the chat. What is it you guys trade? For price to go up, and this is part of the cheat sheet that I would encourage people to have. You got to keep it simple. For price to go up, more buyers, less sellers. For price to go down, more sellers, less buyers. You know that. Everybody in here knows that. But do you know that when the SHIT is hitting the fan and you're a little emotional and you're thinking of trading or you have a position on, you'll lose sight of it. You become emotional. You know that. Now you have to know it like it's the back of your hand. If I need more buyers and less sellers, but I need to predict when they're going to come in or I'm going to be late, what do you need to get the opportunity to have more buying and less selling? You need more shorts, more shorts, more shorts, more shorts, less longs, less longs, less longs. You'll get to that and you'll be able to understand that to the point where you could kind of explain it to somebody else. And those are the tools, whether it's the tool that you use that we have, nobody else has what we have, number one, with being able to use MBO data and turn it into real people's positions and where they're getting stopped out. I'll explain that at another event or maybe a little bit today, but you have to have a tool that is reading order flow in respect to the intent of those orders. Are they opening longs? Are they covering shorts? Are they opening shorts, covering longs? An idea, accurate assumptions, or real assumptions, or non-assumptions, a sample size of people's positions, other people's positions. If you don't remember anything else from today, remember other people's positions. I'll tell you a story of the genie in a second. Well, let me go through these next couple points. If there was a balance of buyers and sellers, and I kind of cover this, what would price do? Nothing. It would move sideways. It would trade because people want to buy it, people want to sell it, but because they're balanced and agree on price, it would just trade in a very tight range, correct? It's not until you create imbalance that you have a prelude to a chase and the opportunity to start identifying good locations. And here's what's also important about identifying good locations. If you've got a good location in your mind and you put a trade on, now you could also watch the same thing you watched to qualify that trade to now disqualify that trade to get you out for a break even, for a small loser, for a small winner, instead of having to take full stop all the time when you're wrong. You don't have to take full stops and just, well, I just know that the price of the market do what it's going to do. Wait a second. If what got you long changed and you could be objective about it, why not allow you to get out? How many times have you guys been long, price is actually going up close to your target and you don't get filled and it comes back down? You had a nice winner turn into a break even and maybe a loss of money. And the worst is you were a couple ticks away from getting filled for a 4 or 5 point winner. Nice winner, but you didn't get filled up there and it came all the way back down. That's real money left on the table. If you're reading the market, keeping your eye on the enemy, not just saying, oh, my skill set is in the resting offer I have in there, and I'm just going to leave it there like I'm standing on the railroad tracks and have no interest in creating a skill to say, you know what, this market's getting too long up here underneath my exit, getting too long. It's probably going to dance lower. I'm going to get out here and take a 3.5 point winner instead of trying to squeeze 2 more ticks out of it. And now how different does your statement look? How different does your P&L look? Qualifying and disqualifying, what we call our step 3, our fire, ready, aim, fire. Qualifying, disqualifying, our step 3, all the same things. That's the win moment to pull the trigger. If you're hunting deer, you don't walk around with the rifle to your face, right, and your hand on the trigger looking for a deer, do you? For hours? You know when to pick up the gun and get ready. You know when to aim, and then sometimes you aim and you don't fire for different reasons. You disqualified the shot. Think about that in a progression you have to have in trading. How many times do you have a support area, and the market's coming down here, and you get filled for a long, and it just goes right through you? Well, maybe there was something in there that allowed you to disqualify that trade, so you didn't have to take that loser. How different does your statement look? Everybody is unwilling. That's why those who are willing to do it are the ones that are successful. They're willing to do what other people are unwilling to do. People are unwilling to read the market in real time to enter and exit their trades. They just want, support at 14. I'll buy it at 14. What's a good target? 18. And a good stop is 2 points because I'm making 4. So 4 point winners, 2 point losers. That's 2 to 1. That's good. I'll buy 14, sell 18s or 12s, and I'll let the market figure it out. And then they're never successful. They're unwilling to read the market to get in, to get out. Why? Because, and it's not always their fault, it's that they don't have the tools to do it. It's just a bunch of numbers on the screen. Now, our tool is called OPP, but also known as the puke tool. That's what we originally called it because it originally, let me look at time here. All right, we're doing all right. We originally just had this tool showing us when stops came out. We didn't know, and we don't know where stops are before they come out, but after they come out, we know. And I don't want to get into a long explanation, but most people that trade, they use buy stops and sell stops to exit a position. Most of the people who use those order types, they use them to exit a trade, generally for a loser. I understand you use a buy stop to get you into a long, but most people use buy stops to get out of a short, right? After you're short, you're a buyer. You hope to be a buyer lower. If not, you get stopped out with a buy stop. We know that a buy stop comes out when it comes out. And what we do is we color it on our chart that we share with a screen share, we color it with a red bar. Why a red bar for a buy stop, Anthony? Because the buy stop is puking short traders, short positions. So it's the color of the position that's puking. I don't want to get into too much of the detail. I want to stay on why this is information that is necessary to have to read to put yourself in a position to qualify better locations to execute your opinions. It also gives you an opinion as to should you be bullish or bearish. So OPP stands for other people's positions. The puke tool, well, the puke again is a that was a phrase or a slang, a term that was slang for exiting a losing position. All right, let's get back to what do I have on this slide? Oh, this is something that I'll actually talk about in greater detail as people when people join the group. There's a lot of videos and stuff that gets into detail. I'll cover some of it now, but I don't want to overwhelm with everything that's on this screen because you don't have to use everything that's a tool on our screen. But what we show and what's important to reading order flow is big market orders that are over 100 buy or sell orders. That's one thing we show on our tool. The other thing is the OPP, longs and shorts, traders opening a new position. That's shown. The other thing is pukes, traders closing their position. All right. And I just showed you that with the color red and green. Laser, I call it a laser. This gets into some details, but it's really cool. It shows you how many longs are short, or how many longs are stuck versus shorts that are stuck, meaning how many longs minus shorts are underwater. If it's green, if the laser is green, there's more longs underwater than shorts in the last 2 minutes. And this we have what I call verticals for this to show what's going on the last 2 minutes, the last 60 minutes, and the whole session. Correlation lines is another thing that we show. It's just also comparing the NASDAQ and the Russell with the ES. And I think that's it. No, icebergs. How could I forget? Icebergs. We show icebergs, which are resting orders that have a lot more left to fill. I could make, and I do have webinars in our group and in our program per all, one per line here. I have a webinar for how to use big market orders and read it when they come into the market. And for each one of these bullet points, there's more than one webinar for to explain how to use it. I just wanted to throw it up here to give people a sense of this is how you could start using this into your trading to highlight and qualify better locations. Period. Is reading other people's positions. Some people use some variation of the delta, absorption, and that's fine, but those are just assumptions of where people might be long or short. I don't know how many people use that. What I will tell you guys is that overwhelmingly, and this will always be the case, overwhelmingly, people never get to this point of reading the market through the eyes of other people's positions. They don't understand after you buy it, you're a seller. After you're long, you're a seller. After you're short, you're a buyer. They don't understand, wow, that does make sense. If everybody's short here, there's a lot of buying that's got to come to the market. Then why wouldn't you look for the tool to be able to read it? I'll walk you through my genie story. If you're on a beach and there's a lot of water here, you're on a beach and you walk across a bottle and you rub it. And let's say the bottle looks like this. And a genie comes out and she says, hey, Brad, Christopher, I'll give you one wish. Any trading data from the CME group you want, you got. What would you answer? How would you answer that? Most people wouldn't know what to wish for if they could get any trading data to be released by the CME. CME group doesn't have the data of where the market's going to close at the end of the day. Talking about data that's happened or happening. What would you want? And most people wouldn't know what to wish for. You'd wish for something that's going to give you a tremendous edge over those that you're trading against, correct? If you don't have an edge, you're not going to get consistent. But if you don't know what the edge is, you're never going to find it. Here's what the wish would be. If I can get all the information that CME group knows, I want to know everybody's position. and as it changes, as they get in, as they get out. So now it's just, we have a sample size. The chart I'm going to show you is a sample size of open longs, open shorts. But if you knew everybody's open longs and shorts, and as they fluctuated again in and out, you could trade, you could put the mouse on the floor and trade with your toes, like you're playing a piano. So think about that for a second. If you knew the whole world's open position, all the traders open it, and they accumulated that, made it nice and easy to see when it spikes up, longs are coming down, shorts are going up, you'd be able to trade with your toes. Now, hopefully after going through this webinar, you know why. That's an advantage and that's an edge, you know, to make that your wish. And so while we don't have from the CME group everybody's open position, what we've been able to do is capture the MBO data. You don't have to be familiar with MBO data. It's just raw data that's useless and unless you know how to filter it. And we've been able to filter it to disseminate when something is put in and it opened a long position, or it's a stop to close a long or short position, and then we present it accordingly on our chart. And oh, by the way, you don't have to take my word for it. I mean, we've tested it, and we actually had a long position or open position, happened to be a long, holy SHIT. I just showed up. All right, I'm going to cover it. It just showed up. So we knew that it was working. But like I said, you don't have to take my word for it, because there are examples of, let me show you this. There are examples of, the chart's going to look like this. There's verticals on there, and there'll be an example of like a green bar that comes out the side. Okay. Let me draw this a little bit better. Let me draw it with this. A green bar will come out the side and it'll be pretty long, which is indicative. And then there's numbers down in here that tells us how big that is, but it's a big long position. And we also track where people are trying to exit that position with little gray lines. But at the same time, this long position comes in, and we got recordings of this and everything else, there'll be a little gray line that will pop in. I'll make it white, but it'll pop in like up here. And we'll see that it's 200 contracts that are offered up there. At the same time, this green bar came in showing a 200 lot long position was opened. And they both come in at the same time. And when the price goes up, fills this 200 lot order, this disappears. If he buys 100 of it, this will get cut in half, because this is tied to this. We're tracking where people are getting in and where they're trying to get out for a winner. We don't know where their stops are before they get elected, so we don't know where they're trying to risk down to. If we did, there would be another huge advantage. But what we do know is where they're trying to exit for a winner. If they get filled, they come out of being long, as what in our calculations. If they cancel the order, then we have to assume that he covered it somewhere else, and we take him off as being long. So let me show you. Today we didn't get an example of that big order happening, but that's just an example, and I'll point you guys to a video. So you don't have to take my word for it that we are tracking longs and shorts. Come to the trading room, spend at least a month in there, and tell me that it doesn't help your ability to find locations, your ability to predict where price is going, because now you're following other people's positions. Pop in questions if you got them. I'm going to show you just a recording of today, and I don't have to take, guys know this from my trade. There's a couple of guys in here that are actually longer time ETG members. Let me see. I know I've seen a couple of you guys, Steven, Michael, John, how are you? I didn't see you in here. But every day, I always record to see, how to give people a sense of, hey, this is predictive. And if you know there's a low coming after you went through the market, go back and see what's common. All right. What's common. And so you'll see this happen all the time. And it's like, let me show you the recording from today. The market rallies up. Here's what I mean about the green bars. That's showing open long positions. This gray line right there are showing exits of long positions. The little gray spikes down in here show exits of short positions. Don't pay attention to anything else. Just pay attention to this vertical right here. These are shorts and the prices they're short from. And then the greens are longs and the prices they're long from. This is the laser, by the way, I was talking about. I want this to be green or just about to go green before I would open a short position. So if you're looking at this 28, 29 area as potential resistance where you want to get short, you don't lay an offer in the book and hope you get filled. It's like you're tied to the railroad tracks. You wait for, what did we say at the beginning of this session? What do you want? What does it take for price to go down? What does it take for price to go down? It takes more sellers, right? And less buyers, correct? More sellers, less buyers. How do we get there? Well, I know that you get to more sellers if you have more longs, right? We know we can get to less buyers if we get less shorts. So it's about people's positions. And now you're looking at them through here. I want to see these greens pop out on that side. This is our puke tool. If it's red, that's shorts puking, less shorts. If the greens pop out, that's more longs. And I'm not cherry picking to show you how great it worked. This happens every day, time after time, where the laser went from red to green. That means more longs are getting stuck. We know longs are sellers. You see the greens pop out. You could see the reds come in and the market breaks. Let me back it up until when it actually happened. So right in here, you get the market too short, not yet. And then this green pops out. Let me back it up. All of a sudden, it goes from too many shorts that got in. They kind of get knocked out and enough greens come in to give you right there, to give you the sense of this is a decent opportunity to qualify a short position, especially if you're already bearish. Then once you're in the trade, you don't take your eye off the enemy. Do you still have longs that are still stuck? Because that's what you need. You don't want new shorts. Why don't you want a bunch of new shorts coming in if you're short? Remember what I said? Too much competition, too many guys in the bar. If your goal is to meet women and you walk into a bar and there's 3 of them there, but 50 guys, that's like being short with too many other people. That's when you disqualify the trade. And so you can go through this and you could see another instance where when we come down in here, a bunch of new longs open up trying to buy these 24 halves, 25s, and they're wearing it. As soon as it gets underneath there, it accelerates to the downside. You get some shorts that come in, stops the price, it goes sideways till that balance goes from short to long. And this is how you start reading the market with and through the eyes of other people's positions. Any other questions? I don't make a lot of my webinars salesy and promotions and offers and things like that. I mean, go to the website, join the foundation for a month, and it's a screen share. It's not loaded on your computer. It's not what charts do I have to have. You can have any charts you want in the world. This is done through a screen share with my analysis in real time over what's going on. So you're not just left to your own devices you got to know where everything is. You're given a legend that explains what each one of these tools are, what they're showing, a video to how to use each one. But then in the room for 2.5 hours every morning, me talking about when it's happening. If you guys are bearish up in here, this is a place not to be long, but to be short. That would be akin to my analysis based on what I'm seeing just with this. These other charts are Russell and it's the NASDAQ. These two charts are both the ES, and you can get lost in the weeds trying to understand everything. And first time you've seen it, just keep it simple. So no matter what you do coming out of this event, no matter what you do, know that other people's positions is where the edge lies. The other edge is having information before the rest of the world, like something geopolitically happened. You can get the information 5 seconds before Bloomberg and AP releases it. Well, nobody has that because that's the other edge. That's the other time you could trade with your feet. If you knew CPI number 5 seconds before the CPI print and it was an awful print, markets are going to break. You get short right before it prints and then it goes down. That's the other advantage. Getting numbers before, news before it happens. Well, I don't have that. Good luck trying to get that. The other advantage is knowing where other people are positioned and getting them stuck and getting them caught and getting them trapped. Everything else is just a lot of hocus pocus about randomness. Like I was at the beginning of this webinar, stuck in the pit. It wasn't fear that was keeping me from trading. It was I had no idea where price was going to go next with no objectivity or no sense of probability, and then being able to disqualify it. I'd buy 55s if I thought 60s and 65s could trade. I'd buy 55s if I thought I can get out at 55 or 50 based on something changing. But I can't buy 55s. This is the Dow prices back in the day. If I have no idea if the next print is 70 or 40, then I'm going to be stuck. I use Sierra, but like I said, you don't need Sierra Ninja. It doesn't matter what you use. This tool is available through screen share only. There's two different ways to have it. You have it all day or just for a few hours a day. But I always tell people to leg into a relationship with respect to anything that you do in education. Leg into it. And everybody here is trading, so you're taking risk every time you open a long and short position. So that's what making a decision whether or not to learn a little bit more and understand a little bit more is. The risk is whatever it costs. But if the rewards could be the difference between where you are and where you want to be, then there's no it's an easy decision. If the risk is $20,000, like some of these education places charge, that's a big risk if they suck, right? $5,000 is a big risk if they suck. But what you have to do is put yourself in a position as a trader is to always manage risk reward in everything you do in life, and especially and including trading. I've been doing this so long that I attach risk reward to what I say to my wife. I know if she's going to kiss me or kick me based on what I say next. Other people's positions, though, get it, understand it, and start going down that path. Screw all the rabbit holes you might have gone down in the past, because that's all they are. Don't be a profile expert. It's okay to know profile, but use that to give you an opinion and use this to execute that opinion. Don't go down Gann and Fibonacci and stochastics and moving averages and Bollinger Bands. Bollinger Bands wouldn't exist if Bollinger's name was John Smith, because Smith Bands don't really go together. So Smith Bands would never exist if his name was Bollinger Bands wouldn't exist if his name was Smith. And the only thing I like about Fibonacci is that he was Italian. Let me answer some of these questions and then we'll get going. I'm going to stop recording for those watching live, but Anthony at edgetradinggroup.com for those that watch this eventually on recording. If you got questions, Edge Trading Group, edgetradinggroup.com is where you'll go to find how to join the foundation to see this talked about with all the videos that explain all this stuff in real time. So Juan, did that answer your question? I'll stop the recording for those in the future watching it.